Reading 31 of the 2018 CFA book, Execution of Portfolio Decisions, Trading. The portfolio decision is not complete until securities are bought or sold. How well the last step is accomplished is a key factor affecting investment results. This reading has made the following points. Market microstructure refers to particular trading protocols that govern how a trader's latent demands are translated into executed trades. Knowledge of market microstructure helps investors understand how their trades will be executed and how the market frictions may give rise to discrepancies between price and full information expectations of value. Order-driven markets are those in which prices are established by public limit orders and include auction markets and electronic crossing networks. Electronic crossing networks are where trading occurs at pre-specified points in time, as well as automated auctions where trading takes place continuously. Quote-driven markets rely on market makers or dealers to establish prices at which securities can be bought and sold. Brokered markets are markets in which the transactions are offset largely by brokers through a search mechanism. Hybrid markets are those, just like the NYSE, that incorporate features of more than one type of market. Execution services secured through a broker include the following: representing the order, finding the buyer, market information for the investor, discretion, secrecy, escrow, and support of the market mechanism. A trader's broker stands in an agency relationship to the trader. In contrast to the dealers provide bridge liquidity to the buyers and sellers in that they take the other side of the trade when no other liquidity is present. The effective spread is 2 times the deviation of the price received or paid from the midpoint of the market at the time an order is entered to the actual execution price. The bid-ask spread is the difference between the bid and the ask prices. The effective spread is a better representation of the true cost of trading than the bid-ask spread because it captures both price improvement and impact. So the effective spread is 2 times the deviation of the price received or paid from the midpoint of the market at the time an order is entered to the actual execution price. Market quality is judged by the following criteria, which are positive for markets' liquidities: many buyers and sellers, diversity of opinion, information and investment needs, and readily accessible location. Also, continuous operation during convenient market hours, a reasonable cost of transacting. Market integrity is in effect the honesty of market participants, a surety of the contract's integrity. Transaction costs include the explicit cost and implicit costs. Explicit costs are the direct costs of trading, including broker commission, taxes, stamp duties, and fees. But implicit costs include indirect costs such as the impact of the trade on the price received. Implementation shortfall is an estimate of transaction costs that amounts to subtracting the all-in transaction costs from the market price at the time the decision was made to buy or sell. So IS, implementation shortfall, is an estimate of transaction costs that amounts to subtracting the all-in transaction costs from the market price at the time the decision was made to buy or to sell the security. Econometric models for costs are useful for obtaining pre-trade estimates of the cost of a trade. These models use many variables such as stock liquidity, risk, trade size relative to the available liquidity, momentum, and trading size. The major types of traders are information-motivated traders who trade on information with limited time value, value-motivated traders who trade on valuation judgments, liquidity-motivated traders who trade based on liquidity needs, and passive traders who trade for index portfolios. Information-motivated and liquidity-motivated traders have very short trading time horizons and are more time-sensitive than price-sensitive in execution. By contrast, value-motivated and passive traders have longer trading time horizons and are more sensitive to price than execution. The two major order types are market orders, which give prompt execution in public markets at the best price available, and limit orders, specifying a price at which the order becomes executable. Market orders are among the order types preferred by information-motivated and liquidity-motivated traders because of their preference. Limit orders are among the order types preferred by value-motivated and passive traders because they are more sensitive to price. Major focuses influencing the choice of trading style include the following: liquidity needed at any cost, need trustworthy agent for possibly hazardous trading situation, costs are not important, advertise to draw liquidity, and low cost, whatever the liquidity. Liquidity at any cost trading focus. Information traders who believe they need to trade at institutional block size with immediacy use these techniques. The problem is that everyone is wary of trading with an informed trader. On the other hand, dealers are mightily interested in finding out whether the anxious trader has any possible valuable information. These trades demand high liquidity on short notice. Costs are not important trading focus. Market orders and the variations of this type, such as market on close, are examples of orders resulting from costs are not important focus. Some investors seldom consider using anything other than market orders when trading securities. Market orders work acceptably well for most mixes of investment strategies in which it is difficult to assign pure information, value, or liquidity motivation. They also mask trading intention since all market orders look alike. Need trustworthy agent trading focus. Buy-side traders often need to execute larger orders than the exchange can accommodate in any given moment, particularly when dealing with thinly traded issues. They recognize their orders may create adverse impact if they are not handled carefully. Accordingly, these traders engage the services of carefully selected floor brokers to skillfully work an order by placing a best efforts, market not held, or participate order. The advantage of these trades is that they match trading desires to the interest in taking the other side of the trade, as such interest is uncovered or arrives. They're usually completed through a series of partial trades. Obviously, immediate execution is not of primary importance. These orders are the epitome of the agency relationship. The trader passes control of the order to the broker, who then controls when and at what price the orders are executed. Advertise to draw liquidity trades. Advertising is an explicit liquidity enhancing technique used with IPOs, secondaries, and sunshine trades, which publicly display the trading interest in advance of the actual order. If public publicity attracts enough traders to take the opposite side, the trade may execute with little or no market impact. Implied in agency orders is an authorization to do some low-level advertising on the exchange floor. Advertising lets the market know a willing buyer is around. That presence may draw out the other side of the trade. However, such an order may bear the risk of trading in front of the order. For example, if a large block order is announced, traders may take long positions in the security in the hope of realizing a profit by selling the stock at a higher price to them. Low cost, whatever the liquidity trading focus, are limit orders typically, and they price behind the market. Either limit buy orders at prices below the best bid or limit sell orders at prices above the best ask. They want to improve the market bid or ask, and these are minimizing trading techniques. These are typically low commission, low impact, but the major weaknesses: execution uncertainty. Algorithmic trading refers to automated electronic trading subject to quantitative rules and user-specified benchmarks and constraints. Three broad categories of algorithmic trading strategies are logical participation strategies, which involve protocols for breaking up an order for execution over time; opportunistic strategies, which involve passive trading combined with opportunistic seizing of liquidity; and specialized strategies, which cover a range of strategies that serve special purposes. That was reading 31.